oil will touch $70 by 31st of May. And we gave the example of silver, that silver took 2 months to move from $50 to $70 and 1 month to move from 70 to 120, because the last 1 month is obviously the blowout month. And within 2 months from 120, it was back to 70. Oil was following a similar trajectory. It took 2 months to reach 70, 1 month from 70 to 120. And our view was that within 2 months, because this war is not going to continue forever, it should come back to 70. It took 15 days more. So by 15th of June, it is back to 75 odd. And again, our view, I don't know what is going to happen in the absolute near term, because as I said, the most volatile and unpredictable person anywhere in the world is Mr. Trump. So in the near term, anything can happen. But 3-4 things. One is, now, even when he says, I'm going to bomb Iran, oil doesn't move up, because people have started, oh, hai na, oh, bhediya, oh, sher aaya. Now no one believes that this is going to happen. And the other thing, the supply side is massive. So all of us believe that, there will be a constraint on supply. Actually, that is not the case. And if you're tracking the news, when the war happened in West Asia, there was this fear that oil infrastructure has been destroyed across Middle East, and it will take years to get it back. But last night Kuwait announced that their 2 million barrels a day capacity will be up and running in the next 15 days. And even United Arab Emirates, UAE, predominantly Abu Dhabi and Saudi, they both said that they would be more or less producing 90% of their rated capacity in the next 3 to 6 months. Also, Venezuela started producing a lot of crude, 1.5 million they've already reached a day, and they can easily go to 3 to 4 million barrels in the next 2-3 years, because they have the largest reserves of crude anywhere in the world. US is pumping in more oil. UAE has exited OPEC, and that gives them the flexibility of producing as much as they want. There's a new country called Guyana, which has massive oil discoveries. They're already at 300,000 barrels a day. They can, over a period of time, go to 1 to 2 million barrels. Russian oil, at least for now, has been allowed to be sold. And that means that Russian oil is also available. And in this memorandum of truce, which US and Iran have signed, obviously Iran has also been allowed to have no sanctions on their oil exports, which is another 3 to 4 million barrels. So there is going to be more than enough supply in the medium to long term. Obviously, as I said, in the absolute near term, there might be some volatility based on what the news flow comes in. The other thing is, when this crude shock happened in March, it was not about the price of crude. It was also about the availability of crude. So if you remember, I think Prime Minister also said that induction furnace use karna shuru karo, because you don't know whether gas will be available or not. And a lot of industries also had to shut down because gas supply was not there. So it was not a question only of price, it was a question of availability also. And I think that has got countries thinking. A lot of countries, including India, have started taking steps. And I'm very sure will aggressively take more steps to move away from fossil-based fuel sources to electrical-based fuel sources. Again, just to give you a perspective, out of the 5 million barrels of crude which we consume every day, 55% goes in petrol and diesel for our automobiles or for mobility. And I think there is going to be a massive push to move the mobility to electric. Because power we can produce, we can put up nuclear plants, we have enough coal to produce thermal power, and solar, we are blessed. We have sunshine 12 hours a day for almost 11 months in a year across the country. And I think there will be a massive push towards renewable. And that would mean that over a period of time, the demand for crude also will start to come off a little bit. So I think a combination of these two things, we believe, is going to lead to softer crude prices going forward, barring some geopolitical war-like scenario which might erupt from here and there. Otherwise, crude is significantly weaker. Anamitra, go to the...
So first cut, your take on the ceasefire and the shape of things for our markets from here, Sunil.
I think it's a big relief. Very few mornings in the past few weeks have looked so good. So it's welcome.
Absolutely.
Anyway, for mankind, it's good that the wars come to end, apart from ceasefire. However, as you rightly said, Prashant, it's a ceasefire. So let's see. I think from an India perspective, the relief is that oil is sharply down. Obviously, Indian markets, the way the futures are showing, are lagging the Asian markets, but that is fine. I think what was happening, Prashant, particularly last 2 days, is that bad news was not being sold into. So I think the markets were already bracing for some kind of relief, and I think this comes as a great relief. Obviously, given the rhetorics which we have seen, particularly from President Trump and the yo-yo over the last 4 or 5 weeks, there will always be apprehension of how this plays out. The other thing to watch out.
I think just skip this. I've already covered this. So on the second side, I mentioned to you that the import duties on gold and silver have been increased. And we can already see the impact. Both gold and silver imports. Gold imports have fallen by 65%. Silver imports have fallen by almost 82%. Between gold and silver, we were importing almost $5 billion a month, which was like a crazy amount. And I think this also should, at least in the near term, aid the foreign, the trade deficit and the forex thing. The other thing which has obviously happened is gold prices in dollar terms have corrected by 30% from $5,600 to $4,100. Silver prices have corrected from $120 to $65. And this whole surge of investments going into gold and silver has now, pacified quite a lot because people like to chase returns, and returns have been negative last 3-6 months. So I think this should also aid India in a way because this was, I would say, non-productive, allocation of forex reserves at a time when we needed forex reserves. FCNR, very, very clearly, if you remember in the past also, the government of India has done these kind of, or taken these kind of initiatives. We had SBI Resurgent bonds, for those who remember. I think these bonds, again, have the potential of raising almost $50 billion. I think this is very important because when oil was not coming down, India's forex position was being questioned. Also, currency was almost at 97. And if for some reason currency would have hit 100, then this government would have been, having a significant loss of face kind of a thing because 100 is optically a very, big number. So I think this scheme which the forex has, which the government has floated, along with the tax benefit which foreigners have been given for investment in government bonds, should lead to almost a $50 billion of inflow. See, all this is very important. Anamita, go to the next slide. Because what happens is if rupee keeps on depreciating, then from foreign investors' perspective, they will never put money into the country. Because, they will keep on losing 3-4% every year by way of depreciation of their currency. And in fact, last year it was 11%. So if you see the chart from 86, it became almost 97. So even if they would have made 10% return in rupee terms, their net returns would have been zero. And Nifty was down. On top of it, the currency was weak, and as a result of which, I think the interest of foreigners to invest in India was very, very low. Now rupee is already at 94.5. The India trade weighted currency is clearly showing signs of it appreciating more. Our view is that 90 is too far-fetched, but at least 93 is something we can look at in the very near term. And that again would be very, very good from a foreign investor's attractiveness perspective because appreciating currency will aid their returns rather than be a detractor to the returns. So this is on it. I think once the currency starts to appreciate, the confidence in the country from a foreign investor's perspective will increase, and therefore our view is that we will see a lot of money coming in. The other thing which has happened is the AI trade. 2 years back, no one knew what SK Hynix was, right or wrong. Now everyone knows what SK Hynix is. I think what has happened is, you're a businessman, you will understand. So when you have to invest a lot of capital and the returns are only 8-9%, no one is going to invest large sums of money to put up capacities, and particularly in a sector where obsolescence is also possible, which is high tech. And in memory, that is what happened. From 2014 to 24, these companies gave zero returns. These markets gave zero return. Absolute basis, the returns were zero. The sectors they were present in hardly had any moat, and therefore no capacity went into it. For example, Intel, till 6 months back, for 20 years had given zero returns. And we all know Intel Inside is, in every laptop you'll have Intel Inside. That was the kind of product they had. Still, they did not give any return. SK Hynix, Samsung, Micron, SanDisk, they never gave any return because there was no moat, as a result of which no new capacities came in. And when no new capacities came in, suddenly because of AI, we started consuming more memory, more processing power, the demand shot up. Capacity was limited, demand shot up. So the pricing for the products of these companies went through the roof. So SK Hynix used to make $25 billion of gross profit on $45 billion of revenue with hardly $2-3 billion of EBITDA. Their revenues went up by $180 billion in 2 years. Their gross profit went up by $175 billion. So the entire, price increase was basically profit for them. Now their ROCs from 8-9% have jumped to 200-300%. At these kind of ROCs, there will be more than enough people who would be willing to put in large sums of money and increase capacity. Already, Tesla has announced a terafab unit in Texas, which will manufacture memories and the fabs and all. So our view is that this is peak profit, and I think the world is also realizing it. We are already seeing a hyperbolic kind of price movement in some of these countries and companies, but the volatility is increased dramatically. Smart money is exiting, retail money is entering. That's why the prices are still not fallen, but smart money is clearly looking at moving away from some of these sectors. And India is an anti-AI trade in a true sense, because Indian markets did not have the potential of offering any AI-related companies, and therefore money went out of India into these countries, and now the reverse can happen when the anti-AI trade happens. Just to give you a perspective how concentrated these markets are, if you see Taiwan, the largest stock is actually now 45% market. So 45% of the market is one stock, Taiwan Semiconductor. In Korea, 2 companies are 60% of the market. In India, there's some mistake here. HDFC Bank is now 6.5% of the market, which is the largest. So India is very, very diversified, unlike Taiwan or Korea, which are very concentrated. So 1 or 2 companies doing well propels their market, and 1 or 2 companies not doing well can collapse the market. The other thing is, India is 140 crore people country. 2 companies, SK Hynix and Samsung, make more profits than the entire corporate India put together. So Adani, Ambani, Birla, Tata, Jindal, all the other industrialists, all the other companies which exist, listed, unlisted, the profits they make are lower than the profits of only 2 companies, SK Hynix and Samsung. So this cannot continue forever. That profit is abnormal profit, and I think that also should basically benefit India. India's weightage in emerging market funds had gone up to 21% in 24. That has come down now to 12%. It's a 10-year low, and very clearly, I think for a country which again remains one of the very few countries in the world, or maybe the only large economy which can double its economy from 4 trillion to 8 trillion. If I'm busy, I will say in 7 years. If someone is bearish, they will say in 10 years. But the direction of 4 to 8 is very, very clear, and it is, I think, highly risky for any global fund to be underweight India when the weightage has fallen to as low as 12%. So all said and done, I think we are very, very clear that the next FII rotation should benefit India. Domestic flows continue to be very strong. If foreign flows also start becoming strong, I think the outlook on the Indian market will also become quite robust. There are a few large IPOs which are slated to hit the Indian markets. NSE, Jio announced today the Jio platform IPO. Typically, large IPOs are not great because too much supply comes in. But our view is that such large and unique IPOs will lead to a lot of new global large investors to have the ability to put in large sums of money. And I think that is a combination FI flows in 26 will be positive. So the next 6 months, at least our view is that it should be phenomenal. Coming to fundamental couple of slides, I think profit growth in Indian corporates was sluggish, but last 2 quarters, profit growth has been significantly better. December quarter as well as March quarter. One interesting thing is the mid and small cap profit growth has been extraordinary. The large caps have lagged behind, but mid and small caps have done very well, which also shows that the breadth of the economy is doing better. The smaller companies, the mid-sized companies, which represent smaller businesses, niche businesses, are doing much better. And our view is that next 2 years, the profit growth can be easily 14 to 15%. So combination of the P multiples being at a 10-year average rather than overvalued, and corporate profit also looking good, combined with macros now improving and foreign flows also looking positive, I think we are looking at the next couple of years with a lot of optimism as far as the markets are concerned. Very, very briefly, I think we all know about the great India story, but just to give you a little bit of perspective, because it will also, gel into the changing paradigm thing, which I will touch upon. We got our independence in 1947. It took us up to 2007, which is 60 years, to reach the first $1 trillion in economy. The next trillion happened in 8, the third trillion happened in 7, the fourth trillion happened in 6. So after 70 years of independence, we have reached $4 trillion of economy. As I said, if I'm bullish, I'll say in 7-8 years we will be 8 trillion. If someone is bearish, they will say in 10 years it will be 8 trillion. But the wealth which we cumulatively created over the last 78 years, the same wealth is going to be created over the next 8 to 9 years. And I think that is the opportunity. So if someone believes that reh gaye hum, I think there is still a long way to go. I'll just repeat the wealth which we have cumulatively created over the last 78 years. The same wealth is going to be created over the next 8 to 9 years. See, this is very important, and this one slide will give you a perspective of the changing paradigm. So I mentioned to you, we took 60 years to reach $1 trillion of economy size. The first $1 trillion of the economy was contributed by hardcore sectors. What were the traditional businesses? Jute, tea, textiles, steel, aluminium, all basic utilities. If you remember, Bombay Dyeing, Tata Power, Tata Hydro, and Birla Jute, and these Century, these used to be the businesses which contributed to India reaching $1 trillion of economy. The next stage, which is 1 to 4 trillion, was contributed by very different sectors. So you had private banks come in, you had pharma come in, you had IT services come in, you had entertainment, consumption come in. And it was completely a paradigm shift in terms of which businesses created wealth. And if you remember and if you recollect, so many business houses which were the largest of largest business houses till 2007, which is the first $1 trillion, they started to come down in their ranking because they did not adapt themselves to the changing realities of the economy. I think this 4 trillion to 8 trillion again is going to be contributed by very different businesses. And we have highlighted some of the businesses here. So e-commerce, these are all from McKinsey report. So very authentic research-based numbers. E-commerce will be $240 to $300 billion in the next 5 years. Semiconductors, again, $100 to $120 billion. Cloud services, cyber securities, EV and batteries, AI software, space. Already, we have one company which is $2 to $3 trillion and still to become profitable. In India also there will be an opportunity. Urban construction, bridges, metros, airports, and so on and so forth. Travel and tourism. People will have a lot of money, will have a lot of time because AI will make our work so easy. So what will we do? We will travel more, we will have more fun. auto components, obviously, and then renewable. So if you see now, this is basically, if you relate to the traditional businesses, none of the traditional businesses are here. इसमें ये कोई नहीं बोल रहा है कि steel, obviously they will all have their, time in, and they will also grow. But the big, I would say, growth areas will be very, very different companies. Some examples and some data points. 1976, if you look at the Dow 30, which is Dow 30 is the 30 stock index of US. And if you see 2026 Dow 30, only 7 companies survived. 7 companies out of the 30 companies which were there in 1976 in Dow 30 are still there. 1986, the Sensex reconstruction happened. Out of the 30 companies which were there in the Sensex 30 in 1986, only 7 are still there in the Sensex as we speak. And I think that clearly shows that if we don't adapt to the changing dynamics, then businesses will have a lot of issue in maintaining their growth. If you even look at some of the current, I would say, companies and, businessmen who have done well, I think Reliance has still able to maintain what it is doing because they have been up there. They diversified out of an old age business like petrochemical into telecom, data, retail. Adani also, from traditional businesses moving to data centers, renewable energy and so on and so forth. I think the same thing is being done by a lot of these forward-looking businesses. Businesses which have not transformed themselves have stagnated. So if you have just continued to do what you are doing, I think businesses are going to, stagnate. And, it's not only about growth, but even if you want to protect and preserve the wealth which has been created so painstakingly by working so hard over the last so many years, I think every businessman, every investor would have to start looking at, what can be the growth drivers and what can be the sectors which can basically lead to India growing from 4 trillion to 8 trillion. Because money will only be made where there is growth. We are in a disruptive world, and Naresh ji told me to speak a little bit about meats, which I will touch upon, and one of the components of meat is also on disruption. So I'll just give you a little bit of background. After working for a long time with Reliance Mutual Fund, joined them after a stint in the broking side in 2003. We were only 50 crores in assets. We were 35th out of 35 mutual funds. So there were 35 mutual funds. We were last, which is very unlike Reliance. But the good thing about being last is कि उसके पीछे तो जा ही नहीं सकते हैं. So last cannot be worse than that. And things worked out well. I think we focused a lot on, entrepreneur-driven companies. And within 5 years, from being the smallest, we became the largest. By 2017, I was heading Reliance Mutual Fund equity investment, managing almost 80,000 crores. And which is when I thought that all my life I have backed entrepreneurs. And here I am chickening out, becoming an entrepreneur myself. So that was a trigger point. Set up Abacus in 2018. When I set up Abacus in 2018, the first thing we did was that, create a good team, because we are a people-driven business. We don't need machinery, we need minds, brains, and we created a good team. And we all sat together and said, let us for 2 days discuss all the mistakes we have made in our investment career, and see how and why we've done the mistakes. And we cannot repeat those mistakes, we can make new mistakes. And out of those mistakes, we created a framework which had worked well, which we called the MEETS framework. And very simple, MEETS. M is management. Obviously, we all know that we should invest in good management. But what is the definition of a good management? Someone who is wearing good clothes, someone who is Wharton and Stanford educated, or how do you say that it is good management? It is such a qualitative thing. So being a chartered accountant and a Marwadi to add, we said that let us try and put everything in numbers. So we said that we will not invest in any company where the return on capital employed is less than 14-15%. Because if a management is not able to generate even 14-15%, how will we generate returns. And that's why if you see, we don't have even Reliance in our portfolio, not because it's not a great company, but the ROC is only 9%. The E is the earnings. We are investing in growing assets. So when you invest in gold and silver, those are not growing assets. And I say this with a lot of humor that if you buy 100 grams of gold today and put it in your tijori, after 20 years when you open it, how much gold will you get? 100 grams. So it's not a growing asset. The only way you make money is when the price goes up, because it will not grow. It doesn't give you dividend, it doesn't give you interest, and it doesn't grow. Equity is a growing asset. If you invest in a company which has 1,000 crore of revenue today, after 5 years, it will be 1,500 or 2,000 or 2,500, depending on the growth of the company, right? Unless you have invested in a very lousy company. So it's a growing asset. And that's why earnings become very important. We would like to invest in companies where earnings can double in ideally 4 years, maximum of 5 years. Because if the earnings double, the value of the business will automatically double even without a PE re-rating. The second E is very interesting, events, trends and disruption. We believe that gone are the days where you could invest for 50 years. Warren Buffett is a great investor, but now if you invest in Coke and say for 50 years, I will not touch my investment, it is going to be harmful because of massive disruption which has happened. And I think disruption is important from an equity perspective. And, that is what I was also touching upon when we talked about a disruption in businesses. See, market price of a stock is equal to EPS into PE. For those who are not, too glued on the equity side, EPS is the earning per share, and P is the multiple which you give. So for a company which is say making 100 crores of profit, and if the multiple is 20, the value of the business is 2,000. It is as simple as that. And the value of the business is dependent more on the PE than the profit, because for the same profit, a company can have a 100 PE multiple or a 10 PE multiple. And P is perception. P is based on disruptions. So newspaper companies earlier used to get 50 PE multiple. Because, if you are used to reading Times of India or an Economic Times, all your life you will read Economic Times or Times of India. But when the digital world came in, the P multiple collapsed, because the view is that the young generation will not be reading newspapers the way we are reading. Or even car companies. In India, the car companies still traded a high P multiple. But if you see globally, car companies like Mercedes, BMW, Stellantis, Volvo, Volkswagen, all great brands, all aspirational brands, they traded 6-7 P multiple. Because the fear is that the world is moving to EVs, and the Teslas and the BYDs, they trade at 100 P multiple, because the traditional car companies are at a risk of disruption. Or even TV channels, all the entertainment has shifted to the OTT platforms. We are now seeing Netflix and, Netflix and the Amazon Prime and the traditional Z TVs and the Sun TVs of the world are losing viewership, and therefore the Ps have gone down. Or even, Naresh was saying that on the FMCG side. See, earlier what used to happen when Hindustan Lever was very dominant, you could sell only through shops. And these companies used to go to the shops and used to tell them that if you store or if you display any other company's product, we will not give you supply. So, it was very sort of concentrated, and therefore you are not exposed to any brand. Now with this D2C coming in, you have now Nykaas of the world, the Mamaearth of the world, pink, yellow, purple, so many other brands coming up. I think they're all eating into their thing, and as a result of which you see Hindustan Lever is growing only at 1-2%. And with them trading at PE of 60, 70, you're not going to make returns. In fact, in 2019, we had released a report called Bubble in Quality, that companies are good, but they might not be good stocks because they are priced to perfection. And actually, if you see last 5-6 years, Asian Paint, Nestle, Hindustan Lever, ITC, Infosys, TCS, they've given you zero returns. Not because they are not great companies, but they were priced beyond perfection compared to their multiples, and the disruption was already happening. T is the timing. We can't time the market, but there is a concept of mean reversion. Many times we get carried away. So when the theme was railways, we bought anything to do with railways. Then shipyard, so that we bought anything to do with shipyard. The same thing happens. And I think what happens is we get sucked into it and we buy the wrong stock at the wrong time. Our view is don't chase momentum. You shortlist your thing. Something will happen in the world where you will get the stock at a decent multiple. And the last is the structural bit. India is going to be a fast growing economy. India is going to be an economy where new businesses obviously will have potential to grow faster, and there you will have to pay a slight premium compared to the traditional valuation metrics. And I think that is what the MITS framework is all about. It is very, very simple, but it is working for us last 7-8 years. So we started with AIF and PMS, then we added an offshore fund. We have a private equity arm also. Between the alternate business, we have 40,000 crores. We launched a mutual fund last year. Within 5 months, we are now almost 6,500 crores in mutual fund. So at least for now, this framework is working because returns of the funds have been pretty decent. But I will take this opportunity to throw the floor open for any questions you might have. A very short synopsis of MITS framework, the market and economy outlook, and a little bit on why, as entrepreneurs, apart from obviously focusing what you're already doing and doing well, you should also be aware of what can be the next driver so that the disruptions cannot or will not impact the existing businesses. Open to you.
Thank you. Thank you, Sunilji, for such a lucid presentation. You covered all the 3 topics about businesses, about investment paradigm, as well as, of course, market outlook. Very difficult for somebody regulated today so closely to actually discuss outlook. You discussed everything that you had to discuss, and without any compliance issues coming up, the way we all are today under the regulations that we are. So, ladies and gentlemen, the floor is open for you to ask questions. Please be brief in your questions so that more questions can come up, and ask questions, not statements. The guest speaker is here to, we are here to hear his outlook and his perspectives. Anybody, please. Yeah.
With the release of lock-in shares, a huge amount of shares will come in the market, and the disinvestment by the government. Every day some issues are coming in. So with this supply, how is it going to affect the market?
So you're absolutely right. I think all the PE funds would be there to sell stock, and government also needs to raise resources. And normally when supply comes in, there is obviously pressure. But see, if the stock is good, if the business is good, there are more than enough buyers, which has already happened. In fact, as I mentioned, if these 2-3 large IPOs come in, they will bring in new set of investors also. The other thing to note is that on the lock-in shares, it is predominantly focused, predominantly in the new age companies which had come out with IPOs, and where the PE investment is very, very high. We frankly don't invest in those businesses, not because we don't like them, but because they don't make profits. So in the MITS framework, one important criteria is that return on capital employed should be 14-15%. These companies don't make any return only, so we don't invest. So I think as investors, you should be also very clear where you are investing. So we also are wary of the fact that a lot of supply will come in, particularly in companies where anyway the fundamentals are not justifying the current valuations.
Thank you.
Sir, I have a small question for you because I have to you said that you need to look at the earnings of the company, but there are a lot of instances where a company which does good at one point of time, and as there is a disruption in every era. So there was a disruption and the company suddenly lost favor, went out of business, but now it's changed its business model and coming back to a new business, and the earnings will improve over a period of time. So would you advise us to invest in those companies where there is a turnaround story, or you would advise us to hang on and wait till the actually we see it?
No, so equity investing is all about the future, but not perpetual future, visible future. You know, so if you believe that there is definitely going to be a turnaround, then you have to be very clear over what period of time, and you should accordingly invest. You know, our view is that the turnaround should not only be in words, but actually it should be visible. And that's why, even if there is a turnaround story, till it turns cash flow positive at least, we don't invest.
Anybody from this side? Yes.
So, sir, we have been reading about how India's demographic dividend will play a key role in the growth of our country. But lately, since post the AI era, so has that demographic dividend turned to demographic tax?
No, I think it's a very important topic. So, we are obviously 140 crore people. Though population growth has eased off and we are reaching a stage where we will be just replacing the population over a period of time, I think the fact of the matter is that even now, a big portion, 65% of our population is below the age of 35 years. Incidentally, 1 out of 5 people born in the world post 1st January 2000 are Indians. So every 5th person in the world born after 1st January 2000 is an Indian. And it will basically become very important for the government to provide gainful employment to them. Obviously, last 10, 15, 20 years, IT services has been a big savior for us. Not only have they employed a large set of new youngsters coming into the employment age, but it has also led to huge service exports. And one reason why India's economy has been so resilient is also because of the huge inflow of this service export which we have seen. This will definitely slow down. We still don't believe that there will be degrowth or there will be job losses overall. But yes, if you have to employ the almost 1.5 crore new entrants to the work pool, India will have to focus on manufacturing because services brought us here. I think for us to now take this economic growth forward, we will have to have a big focus on manufacturing. I think the government realizes it. Some efforts are commendable, some efforts are very slow, but this whole Make in India is now starting to work. On the EMS side, which is electronic manufacturing, we have already seen the likes of Apple and refrigerators and TVs and so many other products being manufactured in India. I think they are employing huge number of people. I think this PLI scheme also seems to be working. The government has focused a lot now on renewables. So earlier only modules are manufactured, now even cells are being manufactured. The whole concept of every house having a rooftop is also leading to a lot of employment. And going forward, I think whether it is semicon or whether it is defense or whether it is drone or aerospace and so many other things, I think work is being done on that front, but much more needs to be done because to employ this 1 crore or new people coming in the workforce is going to be very, very critical. And particularly given the fact that the geopolitical environment globally is not going to be the same as it was 4 or 5 years back, already there is a big pressure, in terms of getting visas and so many other things. I think people getting jobs overseas, particularly to countries like US and all, is also going to be tough. So we will have, as an economy, start to focus a lot on manufacturing because that is the only way we will be able to gainfully employ so many youngsters who are coming in the work pool.
And that too, educated youngsters, because
Yeah.
Yesterday, for example, Uttarakhand has announced it's the fifth state in India to be having 100% literacy now. And the other change that is happening, Sunilji, you must have noticed, is that the erstwhile occupations being done by people who are less educated, their next generation who is more educated or differently educated, are actually not wanting to go to the erstwhile thing.
I'll just give you some data point. If you are a computer science engineer, it's difficult to get a job in Germany. But if you are an electrician, there is a shortage of electricians there. So it always happens, in 2006-07, the financial markets were booming. All youngsters wanted to do only business and finance. And last 10, 12 years, the computer science market was booming, and including my son, all the youngsters wanted to do only computer science. So that always happens, I think there will be a reset somewhere. And you're right that, everyone is going to be more and more educated. And it would therefore all the more reason that we create manufacturing jobs so that we are able to gainfully employ more and more people in hardcore manufacturing.
Thank you. Any other question, please?
Sir, I have a small question.
Yeah.
Recently, what
Just wait for the mic.
hello. So recently what we are saying in last maybe 2 years, most of the IPOs which are happening, they are basically giving exit to private equity funds who had invested in the company maybe last 5-6 years. And typically a PE fund's investment in a company is like 5 to 6 years only because of the fund life. So originally what we used to understand as capital market, that when IPO is happening, it's basically companies raising the capital for future growth. But in this case, basically the cap table is changing from one PE fund to thousands of retail investors. So, and most of the, after IPO, you can see that after listing, the prices are ruling at 40% discount. So how do we navigate this, and how, what as regulator perspective also, and since you are looking after investments, so how to take care of this situation? Thank you.
Few things. One is, see, PE funds also have space, because 5-6 years back, these companies were very risky companies. Your capital would have also become zero if the companies would have not performed. And there would be so many companies which we don't even know where PE funds would have invested and they have gone belly up. So PE funds by nature are high risk, high return investments. They invest in 20 companies, maybe 2 or 3 do very well for them, and that's how they make their money. So it is their job. As far as IPOs are concerned and regulations are concerned, I think we are in a world where we are in a free pricing mechanism. So the companies are free to price the IPOs the way they want. I think it is on the investors to take a measured call of whether they should be investing or not. So now, if you're very clear that it is PE selling and the price is going to list 30-40% lower, why should we even apply for IPOs? But greed takes over. So people just invest just because they believe that the price is going to go up rather than on a fundamental basis. I think as from an institutional perspective, every institution will have a different perspective. I mentioned our MITS framework. We will never invest in a loss-making company. So every investor will have its own, their own way of investing. Some would be high-risk, high-return investors. Some would be a little bit more conservative investors. From a retail perspective, my suggestion would be that, just don't apply because you are expecting a pop-up. Apply only if you want to hold the stock for 4-5 years. Otherwise, you're better off if you're a pure retail investor or a investor who does not have the time to invest through mutual funds. About?
You mentioned about energy, fossil fuel. One of the, you mentioned
Is
electricity,
ethanol,
but ethanol is emerging as a big.
So ethanol, the government of India is focusing a lot because obviously we are very strong in agriculture. And we have surplus sugarcane, we have surplus broken rice, we have surplus maize, and we have already reached 20% mixing. Now it is good, but what typically happens in this, some of the other crop we have a shortage, and then the government will say now this year you can't use rice to make ethanol. So some other time they will say now you can't use sugarcane to make ethanol. Sometime they will say that you can't use maize because obviously first you would want to fill the stomach. So I think this whole ambition of raising ethanol share to 30, 40, 50% is not going to happen. Even if you are able to maintain at 20%, it would be pretty good. You know.
So is there any risk of rainfall of 60% deficient? So its impact on the market also?
I don't think there will be a 60% efficiency as far as rainfall is concerned. It is delayed, but we have not seen that kind of deficiency ever. A 10-12% deficiency is easily manageable. The water table, because of the great rains last 3-4 years, is significantly higher. Water storage is 20-30% higher than the 10-year average, except in south. A lot of work has been done on irrigation. And anyway, the summer crop is a smaller crop. I think we depend a lot on the winter crop. So, abhi tak to we should keep our fingers crossed. I think it's too early. Sentimentally, if rainfalls are deficient, it does have an impact.
Nilima ji, anything? Any question? Yes, yes.
I have a question. When you spoke about mean reversion, about stocks coming from the which are very volatile coming down, do you have any sectors or any stocks or anything you see coming up?
Yeah,
on the
that
mean
is our
reversion?
job.
Which ones do you see?
That's in our portfolio.
On sector wise, if you have to look at it.
No, I think, one thing about India is that we are very diversified. I mentioned to you the largest company is like 6%, 7% of the index. We have 6,000 listed companies. It's a country which is driven by entrepreneurs. And I always say this, that we grow because of entrepreneurs and despite the government, not because of the government. And we are also in a dynamic world where new companies, new sectors are coming up. And in fact, I was just addressing a bunch of 60, 70, 20-year-old kids only 3-4 days back. And, kids are bright, but their attention span has gone down significantly. You can't even make them focus for more than 2-3 minutes. As a result of which they don't read, they don't observe. So I was just telling them to be observant. And I was giving them an example that, when my son was born in 97, the government, the doctor gave me a prescription to buy 3 injections of hepatitis B. And, I'm very middle class. That time, no credit card. You had 200-300 rupees in your pocket. You went to the medical store and he said that 10,500. And I said, okay, I'll come back the next day. But if you're observant, I saw the injection. It was made by a company called SKF, which is now Glaxo. And I was just telling myself that if every kid is going to be taking this injection, see the demand which it will have in India. And I bought 100 shares of that company, and all my medical expenses on my child got paid by that one stock. So you have to be observant. So you don't need to, in fact, ask me. If you are ordering Swiggy and Zomato every day, if 3-4 years back you were observant, you would have known that this is the trend. If you are observant that instead of a public sector bank, people are opening accounts in an HDFC bank, you would have been there. If you would have seen that everyone is, investing via a SIP, you would have invested in an HDFC AMC or a Nippon AMC. So I think just be observant. You will automatically figure out what will do well.
Any other questions, please? Some wonderful questions have come actually. That was there. Okay, so can I now request? Can I now request Mr. Achyut Chandra, Chairman MSME Committee of the Chamber, to give a vote of thanks to Sunil ji.
Sri Srinanyam, members of the chamber, distinguished guests, ladies and gentlemen. At the conclusion of the third session in the Bharat Chamber Knowledge Series on changing paradigms for business and investment success, it is my most pleasant duty to propose a hearty vote of thanks to Sri Sunil Singhania, founder, Abacus Asset Management Private Limited, for sharing his insightful perspectives on investment, wealth creation, and evolving business landscape. In a world where markets are constantly evolving and business models are being redefined, success increasingly belongs to those who can adapt, innovate, and remain focused on long-term value creation. As business models evolve and global markets become increasingly interconnected, the ability to identify long-term opportunities while staying grounded in sound fundamentals will continue to distinguish enduring success from short-term gains. With these words, I would request all of you to join me in carrying a hearty vote of thanks to our guest speaker, Sri Sunil Singhania, with appreciative acclamation.
Sir, before we conclude today's session, we have two mementos that we would like to present to Shri Singhania. With that, we would like to close the third session in the series, Bharat Chamber Knowledge Session. Learning is progress. Thank you so much for joining us. I would request everyone to please join us for high tea.